Good afternoon, everybody, and welcome to our very first EBnet in the Moment live event. I can see some of you have already figured out the chat functionality, so you can all go ahead and start posting your comments and thoughts there for now. But by way of a welcome, a very, very warm welcome to the trustees who are online today and other decision makers, including management committees. Welcome to all the consultants, both our individual consultants and our employee benefit consultants. I see most of you are online already. Welcome to some of the regulators and some of the press. And we're looking forward to a very, very interactive session with you today. The scene is set. For the first time in history, the ANC didn't secure a majority vote. What that means is they now need to play with some of the other parties in order to run the country. What does that mean for us, and what does that mean for investments? Well, the good news is you're not going to hear my opinion. You're going to hear from two leading experts from some of South Africa's largest investment managers. But before we get there, for those of you who are not familiar with our webinar platform, if you look to the top right-hand side of your screen, you will see the chat. As I've mentioned, I can see some of you are already posting. Yes, we are recording. Thank you for asking that. You can also see above or right next to the chat box, you can see polls. There may or may not be some secret polls during the session. And depending on how vocal you are and all your questions, we may be prompting some discussion and checking in with you around what your thoughts and opinions are on whatever we happen to be discussing at that moment. So the most important question, where I see that it's the volume, okay. The most important question for most of our consultants and advisors and reps on the line today will be around CPD points. We will be sending the session off to the FPI for accreditation, and once we know how many points the session is allocated, you will be receiving. Thank you, Leon. You will be receiving a certificate confirming your CPD hours for today's session. So we will take care of that admin for you, and that process, as you know, takes around 2 to 3 weeks. So right. I think if we look at where the country is right now, and after the elections that happened at the end of May, we have some very, very optimistic people, and the markets responded very positively to it. But there is a healthy dose of skepticism. And I'm very keen to hear from our presenters today around which side of the fence they fall on. So without any further delay, let's welcome our two men on the spot. Sorry, I mean in the spotlight. Firstly, starting with Patrick Matidi. Patrick is taking some time out from watching the Tour de France this afternoon to spend some time with us. Patrick is a founding member. Patrick, if you could join us on stage, is a founding member and head of multi-asset strategy at Aluwani Capital Partners. He's a multi-asset portfolio manager whose skill set is in understanding the broader macroeconomic dynamics. Welcome, Patrick.
Thank you, Natalie, and thank you for having me. And a good afternoon to everyone on the line.
You're welcome. Our next presenter is Sandile Malenga. Sandile is also a keen cyclist, although Patrick did tell me in our session earlier this morning when we chatted that mountain biking isn't a real sport. But having said that, Sandile is the Chief Investment Officer for multi-asset at M&G Investments Southern Africa. His role also involves providing analytical and economic support to M&G's investment processes. Welcome, Sandile.
Thank you, and thank you for having me. Good afternoon to everyone. It's okay, I'll take Patrick out for a ride when he's next in Cape Town.
Yeah, I'll let you two sort that out. Okay, so today's session is a friendly debate. What we'll see is we will give each of the presenters 10 minutes each to share their thoughts on the new government, the new coalition government, and what that means, both at a macro level, but also very much down to the detail of Natalie Burrows and what that means for her personal budget, which is what I'm very keen to hear. Things like interest rates, inflation, et cetera, and most importantly, when am I going to have uninterrupted power? So I'm hoping one of you can predict that for us. So we're looking forward to some lively debate. Each of you will be given 10 minutes. I'm going to time you, and as you approach 9 minutes, I'll come back on stage, and so you can start wrapping up. And because at EBnet we walk our talk, we're going to decide the order of events by way of a coin.
Coin toss.
Hopefully, yeah.
Button. So there we go. All right. Sandile, heads or tails, sir?
Tails, please.
Tails for Sandile, and let's go. Tails it is.
Excellent.
Sandile, you have the fortunate position to decide whether you speak first or whether you send your opponent on stage first. Which you're going to choose?
See, the danger of this is if I send Patrick first, he might steal all of my notes. So,
right.
So I think I'll go first.
You'll go first. Okay. First. Well, in that case.
Yeah. So I mean, as the topic sort of starts off, Natalie's brief was quite direct. Effectively, she asked us to gaze into our crystal balls and give a sense of what we think the elections mean. Certainly, I think for it's probably a consensus admission that certainly the expectation that a year full of global elections as we're seeing in 2024 was going to be a year full of surprises, and our last election in South Africa was no different. And I think one of the things that had worried some keen observers and certainly the election organizers themselves, was given that the polls were predicting something of a seismic change in the shape of the government, there was some skepticism about South Africa's ability to accept the change for a peaceful transfer of power, if there was one to take place, and what's that going to look like, and how is that going to be if there's some sort of power sharing agreements that need to be brokered. And I think certainly when the results came out, they were surprising, but the most surprising thing was, and certainly if you look at any other economy that's been governed in a sort of national unity framework, the fact that we've managed to build a government of national unity in as quickly a time as we have is something that we really shouldn't dismiss out of hand. It really is quite a profound and fundamental statement about the maturity of South Africa and the maturity of the political economy. And even in places where you would historically have expected to be, a hotspot of some level of violence, KZN and Gauteng are obvious examples. We saw none of that. And if there was some, contestation, all of the parties, despite some ramblings, really went through official channels to voice some of their concerns about the election and to lodge any concerns with the IEC and the Electoral Court. And I really don't want to over-egg the result and what's happened since then, but really the fact that we've had as peaceful a transfer of power is something that we should be proud of, and something that speaks a lot about political parties and some of the political actors and really their commitment to the Constitution and to the rule of law. And that is not something that you see in other countries. I mean, there was a sort of attempted coup in the US in 2020. So we really shouldn't take it for granted. And I think the second thing that's been quite surprising is really the reaction of the financial markets. I think, if you had given anyone the playbook and said, look, perfect foresight, this is what's going to happen. There's not going to be a majority party in Parliament. There's going to have to be, people reaching over across the aisles. There's going to have to be a government of national unity. The ANC is not, going to be able to have its way for the first time in 30 years. And you asked anyone who's, a keen observer of financial markets and political economies, they would have, probably told you that there's a lot of uncertainty involved and things are going to be quite fractious, and they don't think this is going to work. So I think the fact that, you've seen something resembling a relief rally post the results speaks to that in some way. And the fact that, a lot of people who, were quite skeptical of the fact that you can hand over, and share power and actually get on with the business of governing have certainly been proven wrong in the short term. And like Natalie sort of touched on, it's still quite early to say. So we're not quite sure how durable the contract between all of the parties at the table is going to be. We're not quite sure how, what the commitment to existing policies is going to be from the various stakeholders. And really, we're not quite sure how things are going to pan out. And if, we are going to see some level of responsible governing in a brand new sort of framework. And I think finally, we always say there's two ways that you can be surprised in financial markets. First of all, the event can surprise you. So the election outcome in South Africa was surprising. And the second way you can be surprised is a market can surprise you. So, the rally post the election was certainly quite surprising, and it surprised a lot of our peers and in some instances ourselves as well. But we always need to be open and vigilant to being surprised by other events. And, we're only halfway through the year. And there's still some big elections coming up. And, we've seen 2024 is the year of massive election surprises. So Mexico, India surprise election was called in France, and the UK also delivered, quite an emphatic mandate to the Labour government. There's still something to be said about the massive cloud of uncertainty with regards to the US election in November. So, while we always say, the US, when the US coughs, the rest of the world catches a cold, is the same is going to be true for these elections. So while we might be out of the woods, we're just not sure what it's going to look like in the US. So, that's it from me, Natalie. I just wanted to, make those opening remarks and just, I guess, point to the level of surprise And that always, leads us to be quite humble and quite careful in our analysis, and to hold our views quite lightly while we're trying to navigate some of these markets for our clients.
Well, you caught me a little bit by surprise, because you only took 6.5 minutes. So Patrick's happy now. 3.5 minutes to share his views. When you said markets can surprise us in one of two ways, I thought you were going to say they can either go up or go down.
That's certainly true.
Okay. Patrick, have you had to change any of your slides or any of your thoughts? Can we hand over to you?
Not at all. Not at all. So, yeah, I think thankfully, quite a lot of similarities, but I think, one or 2 points of difference. But nevertheless, I think just to kick off, if I look at the subject matter for discussion, it falls fairly into our framework in terms of what we go through when we're looking at investment opportunities for clients. So as part of our process and on a quarterly basis, we sit as a team and we identify themes, that we think have got a bit of longevity, but also have got the potential, to impact, returns for financial assets. So at the start of the year, we did flag as a team that indeed 2024 would be different in a few ways. One is, obviously, as Sanil has mentioned, it is a big election year. I think about 25% of the global population by the end of this year would have gone to the polls, in some form or shape. And that on its own is not so much a big deal. I think the bigger deal is the fact that, we've seen a shift in terms of outcomes, when these elections have taken place, all the way through from, I guess, when Trump came on to being president of the US, we saw the trade wars that played out as a result of that. So the policy change, that is what we always are alive to, what we need to be cognizant of as investors. And hence, when we go through elections and see, what's the likely dynamic at play, it is with that lens in terms of the impact on policy, which clearly impacts the businesses and the companies we invest in, and therefore the returns that we can expect, out of those financial assets. So elections have been a big theme this year. It has played out in SA and other regions, but to the extent that a few other countries remain, I think that will remain on the radar from our perspective. The second area that we have been watching, again from a thematic point of view, is China, right? In terms of its recovery prospects. China is important to SA from a commodity export point of view, demand for our commodities, but also, it is important in the sense that if you look at our fiscus, we had a reprieve, in the last 2 fiscal years in the form of super taxes from mining sector. So to the extent that we do get some commodity boom or some recovery out of China, that can have big prospects, for the SA economy. From a fiscal point of view, but also, from the mining stocks point of view, in the form of, good earnings and hopefully good dividends. As you may note, for the first 6 months of this year, China has faltered. It has not come through to the party. Pretty much similar to what we saw last year, but hopefully, as the year progresses, it will get better and better. So that's the second theme that we've been keeping an eye on. And then thirdly, last but not least, the whole higher for longer inflation and interest rate theme that has been playing out both domestically and globally. So if you look at SA in particular, inflation has been sticky, right? If you look at earlier on in the year, in the US especially, there have been hopes and expectations for a rate cut to have come through, but that has continued to be delayed, further and further out. Hopefully, it will start to kick in sometime in September. Similarly with us, our MPC are meeting this week. I don't think we'll see anything yet, but hopefully by September we'll get a first rate cut. Other central bankers across the world have started. If you look at the Bank of Canada, the BOE, and also the ECB, which is a good omen. So that environment, that global backdrop provides a nice scene for SA, the economy itself, and also for assets in South Africa. So it's important, therefore, to have a proper handle on what's happening globally, given some of those themes, because that can influence, the return that you can expect from some of these assets. So coming back to the subject of discussion, that being the elections, right? So again, I won't regurgitate the outcome. Suffice to say that, the outcome from a market's point of view has been positive. To us, it was not overly surprising, because we do go through scenarios where we try and understand, the likelihood of one scenario playing out, given the various themes. So indeed, we did see a re-rating of sorts coming through to financial markets as a result of this positive outcome. I think what was a bit nerve-wracking, though, was, it was almost like a horror movie where anything could have happened. Someone could have come through from the side and, topple the whole thing. So thankfully, a lot of maturity came into play. The guys managed to find each other. We now have a GNU in place, and we'll hopefully see or hear what the president had to say coming out of the Ghouta the last, 2 days of last week. So we are on this sweet spot. We're sort of, enjoying the afterglow, given this, the outcome of the elections. However, there are risks from our side, both in near term and also structural, right? So looking at, let's say, the rest of this year of 2024, I think some of the points Sanila did touch on, but for us, if you look at this government of national unity and look at the cabinet, one can't help but still see the ANC dominance in the cabinet, right? There are about 71 or so ministers and deputies. Out of 34 ministries, right, the ANC has got 22, right? And out of 38 deputies, the ANC has got 31, right? And if you look at that picture versus the election outcome, it is a bit lopsided, right? Which means, therefore, that the propensity for squabbles, for disagreements, for misalignment is very high. Not only because of the numbers themselves, but because you're putting in different guys from different angles into one pot, and hopefully hoping that you can steer them into one direction and they do the best they can for the country. So that's the one thing to flag at this point in time, that the fact that you've got this lopsidedness in terms of the numbers, but also this melting pot that is supposed to then result in a unified view going forward. So we'll have to see how the guys actually play out in the next few weeks and months, running into the rest of the year. The second issue that one cannot ignore is the fact that there is no tested dispute resolution mechanism. So especially given the first point of this large cabinet with different guys coming from different angles, how you then manage disputes, disagreements, becomes key. So in my reading of the contract, it appears as if there is an opt-out, as in if you don't like something and you debate, but you lose the debate, you can always work out, which is not great from a stability point of view. And we've seen this play out, in the provincial sort of coalitions. And the classic case currently playing out is Johannesburg. If you look at the metro, where you do not have a GNU in place, and it's not clear to me how that will play out, versus what's happening at the national level. And then the other point to mention is, as the weeks and months unfold, the strength of the opposition party becomes key. So currently, the official opposition is MK and EFF, right? So as to how they'll behave, how they'll take their role seriously in terms of holding the executive to account remains to be seen. And even though we've had utterances from the EFF that they've grown up, they'll behave, there's always that risk that this thing just becomes what we have seen the last couple of years or so. So having said all of that, right, as we look into the second half of the year and trying to come back to the subject matter of discussion, one can't help but be positive, right? So one is positive from two folds. I guess as a citizen of the country, we've been in the doldrums for too long. You kind of need to be positive, otherwise it just becomes too depressing and you can't jump off a cliff. You can't find one that is high enough in Joburg anyway, right? So you have to be positive. And secondly, as investors, we are forever positive because that's the nature of the industry, right? No one wakes up to see a market crash. We all want to see the market goes up, and we think that there is more than enough currently on the table, to propel that optimism. So some of the things that I think are positive and are likely to play out in the next few months leading up to the year end is rate cuts, both domestically. As I've said, globally, we've seen other central bankers starting to cut. I think domestically, it's a matter of time, before the MPC cuts. The markets are pricing in the first cut in September, so hopefully that comes through. Yes, it won't be a deep, sort of a long cycle. It will be very shallow because inflation is very sticky. But nevertheless, every bit helps in terms of sentiment from a consumer point of view, in terms of markets, in terms of also I guess in just the overall feel good that permeates the country, just given how strained the consumer has been from that point of view. I think the 100 days of no power cuts, I think that's a plus, right? So yes, we've come off a low base, but hopefully it's not a fluke. It seems like there's a lot more work that has been done, which is a lot more sustainable to can then see continuity in terms of less disruption in terms of power going forward. That is key, because as and when the economy grows, right, assuming that this cabinet is aligned and there is proper policies to can stimulate economic growth, we will need the power to can grow the economy going forward. The last thing you want is for the economy to stall because of power shortages and. Port bottlenecks also are being addressed, so that is a plus. And then the global backdrop is still also very supportive, right? So if you look at global GDP growth, you look at interest rates, there's a lot of optimism there, and that is evidenced also by the all-time highs that the markets are hitting almost on a daily basis. So yes, a lot to be grateful for, and barring any external, left field event, I think there's a lot still good in the rest of 2024. But again, I mean, not to be a party pooper, we do have long-run structural issues that we'll need to address. And if we can get this journey to focus and execute meticulously over the next couple of years, I think we've got a better chance on a 5-year view. Thank you.
Your comment around the horror story, it's not the horror movie we expected. It sounds like we're in a bit of a rom-com phase, but with the potential of a horror movie outlook in some stage in the future.
Yeah, hopefully not so much of a Chainsaw Massacre type of a horror show, but something a little bit more lighter that even teenagers can watch, right? But I mean, if you look at the horror show, and this is the fallacy of predictions, right? I mean, I went back and I tried to find, if anyone has got that information, please share. But I went back and I tried to find any pollsters out there from all the organizations, all reputable ones, that came close to the actual outcome, right? And it's actually very scary what guys were predicting versus the outcome. So which then, again, from an investment process point of view, you can't put all your eggs in one basket and say it's red or black. You kind of need to be diversified, have a view around the risks around the central view, but you can't definitively say on the 29th of September, when the elections count is done, the outcome is going to be A, B, C, D, and then I'm going to do X, Y, Z. That's just not the way the world works, unfortunately.
Sandile, do you have any comments to make to that? Any other thoughts you'd like to share?
Yeah, I think on the CSIR was quite was very close, in fact, Pat, on the polls, and Ipsos wasn't too far, certainly in calling the ANC take. They sort of over-egged the EFF and underestimated sort of MKP's take of the election. But once again, it's one of those, and you're 100% right. The notion that you can have a sort of certainty around a specific event and then build a portfolio around that is certainly something that we philosophically don't agree with and we don't think is possible. However, one of the things that we probably differ a little bit on is, the ability of, sort of central banks to deliver, that sort of a soft landing, if you will, because that's effectively what the market is pricing in. Everyone is no longer talking about recession. People aren't talking about the fact that inflation is sticky, and what is that 2.5-3% globalized inflation rate do for nominal interest rates, and are we going to go back to a world where we now have to contend with a higher real rates going forward to try to keep a lid on that inflation? And we simply say we don't know, right? We don't know. So what we're trying to do is to try and make sure that the assets that we are buying have a lot of margin of safety. And one of the things that I think we've probably differed certainly a lot with the market on is, the cheapness of South African assets, and what that, so what that sort of means for how you should position your portfolios. And I already saw there's a question online. Is this the point at which you want to be going overweight South African assets, or are you still going to be structurally underweight SA Inc. assets? And I think one of the things that certainly we have seen is this notion that because South African growth has been structurally challenged, South African companies will be unable to deliver decent dividend yields and decent real earnings growth rates for investors. And the work that we've done and the work we've looked at doesn't suggest that. There's very little relationship between nominal GDP, if you will, even nominal GDP per capita, and delivered returns for assets. So we have certainly placed less store on the interest rate cycle, because we sort of are quite skeptical about in the sort of normal course of business, the ability for central banks to control economic variables, or to engineer any sort of soft landing. What we've sort of been quite encouraged by is, even in a challenged macro environment that South Africa has been through over the last 10 years, South African companies have delivered, reasonable earnings growth. 4.5-5% real earnings growth per annum is pretty decent. I would challenge people to find another economy that's able to do that in a durable sense. Even the US, a lot of the earnings growth has been delivered by 3 or 4 companies, and the rest of the S&P, if you want to look at that index, has delivered fairly meager earnings growth rate. So I would caution against looking at nominal GDP rates and sort of making a sort of through line relationship between that and your and what you can earn from your equities. But yeah, getting back to the topic, I think it's very much the case that there's definitely warranted caution, especially about the ability of a GNU government to execute on existing policies, let alone new policy measures that they might want to pursue as pet projects. And certainly, I think that's the one area that has potential to derail this this whole Ramaphosa 2.0.
I like that. Just to go back to Patrick on that, the question that Carl asked was around consensus being in the past around being overweight to SA Inc. And whether you were concerned about the next growth phase, or are you going to be overweighting SA compared to offshore? So Sandile has hit some of his thoughts on that. Would you like to share yours, Pat?
Yeah, so I think a few things to in answering that question. One is, when assessing the state of the economy, right, whether it's interest rates or inflation, whatever, for us, it's important to have a handle on that, because companies do not operate in isolation, right? So ultimately, we invest in companies, right, in terms of the fundamentals and the earnings and what drives that, but it is within a particular environment within which they operate. So it's important to have a clear understanding of that environment. Yes, there may not be a cause and effect link in terms of some of the prospects, but the environment actually still matters. You still have to go back to the fundamentals and try and get a sense of what that company is valued, given its own fundamentals and its own challenges in this environment. So that's the first thing. So in answering the question, for us, we don't invest, in, let's say, equities. We invest in companies, right? So each and every company that finds its way to the portfolio gets there on its own merits, right? Based on what we're seeing, given our own process. So when we then look at the portfolio holistically and collectively, right? Yes, it then exhibits certain characteristics, right? Which may then be SA Inc. versus, let's say, Rand hedges, right? But we do not start with a blank piece of paper to say, we like SA, because interest rates are coming lower, GDP is growing up. So let's go find SA Inc. stocks. Now, that's not the way we approach it, but it's all bottom up, see what's offering value, and then build a portfolio that way. Currently, given how we build portfolios and how we assess investments, the portfolio is balanced between the SA Inc. and the rand hedges because we find value in the different buckets based on the individual companies and their own merits. Right? So if you look at banks, for example, we'd not like all 4 banks, even though the environment may appear favorable to all, because there's 1 or 2 that we think will do better compared with others. Right? Similarly with mining stocks, even though the rand view may be, okay, the rand could flatten from here, we're not piling into the rand hedges simply because of that one variable. Right? It's all bottom up, and then that's how we then construct portfolios. I hope that answers the question.
Thank you. I thought you constructed your portfolios using artificial intelligence and then just doing what ChatGPT told you to do.
So, between the two of us, I'm the artificial intelligent one.
I doubt that. I doubt that. We've got another question from Carl, which we're going to take quickly, and then maybe hop to a poll or two to see what everybody's thinking in the room. For Sandile, Patrick mentioned that Eskom is improving. Are we seeing the same improvement with Transnet? What does this new GNU mean for policy reform, SA economy growth? Look, there's a lot of questions in there, but your views.
So I'll take the first question. I'll answer them in reverse order. Yes, South Africa needs growth, but it's what kind of growth are you looking for, right? So if we look at, and this sort of touches on the topic, which is, if you look at the elections in Mexico, the reason AMLO's party received an even more emphatic sort of mandate, left-leaning popular mandate, is quite simple. They've been able to generate 5 million new jobs. They've been able to raise real wages in Mexico over the last 5 years. They've been able to ensure that the unemployment rate, structural unemployment rate, goes down. If you can do all of those things, surprise, surprise, people will vote for you. So it's really that straightforward. And we don't have a shortage of policies in South Africa. We have, quite frankly, SAST have been able to implement even the most straightforward of policies, which brings me to the second question of Transnet. So, quite an interesting stat. South Africa sort of accounts or owns more than 95% of the rail network on the African continent. So, one of the sort of really interesting things about that is clearly there's an infrastructure backlog problem, especially in rolling stock and modernizing the rail network. And the question is really whether Transnet itself is best placed to do that. There's some question marks around that. So, what is the policy prescription for fixing Transnet's backlog? It's really to open up some of the network to more efficient private sector operators to operate. So Transnet will still own the rail network, but those operators can then start taking some of the tonnage that's sitting in a backlog that Transnet itself is unable to move through from a port to the various points within inland. And yes, there is still some uncertainty about whether they'll be able to put in place a sensible enough policy such that you can entice enough private sector players to deal with the backlog and also to modernize and make efficient the rail network. We saw the same thing with telephone networks with Telkom in the late 90s, and we're probably going to see the same thing across other network industries. And we really have to decide, and when I say we, I'm effectively talking about South Africa, whether we want to choose and implement policies that encourage a sensible economic growth, or we're going to have debates that have already been settled empirically in other countries. And that sort of brings me to to Eskom finally. Once again, the thing that really fixed Eskom is not rocket science. It's back to basics engineering. You have plants that are old. If you don't maintain the plant, if you don't fix the plant today, it's going to cost you double to fix it in a year's time, and it's going to be a less reliable plant. So we found ourselves in a scenario where a lot of Eskom's, the average age of Eskom's fleet is significantly older than what we would say a sort of modern economy should have. But the performance of that plant is not surprising. If the plant is more than 60 years old, it's going to break down. And you see it in different economies. So in the US, in California, they also faced aging a fleet. And lo and behold, the reliability of that aging fleet was almost step for step the same as Eskom. So, the one metric that you look at is the energy availability factor. And if there's an interplay. If you don't do enough planned maintenance, then the unplanned outages are going to far outstrip the planned outages. And once we, stop messing around and actually embark on proper maintenance plans, lo and behold, a few months later, the energy availability factor sort of stabilizes, and suddenly the lights are on for a lot more reliably. But that's on the generation side. I think to answer your question, Natalie, when will you have reliable lights on reliably? They're sorting out the generation part of the equation. Now it's the distribution and network part of the equation. And there's a massive amount of capital that needs to be invested there to ensure that, yes, you can put solar panels all over the Free State and Northern Cape, but how do you get those, to quote the Minister of Electricity, how do you get those electrons from Kuruman to Joburg, and that requires a slightly different type of network than the one that we've built so far.
Right. Okay, I think we're going to take a break from some of the questions. I have earmarked them in the chat, so we will get back to them, and maybe head over to a poll or two, and maybe get the audience's views on certain topics. So there we go. So for the delegates on the line, you can see in the top right of your screen, will we maintain inflation at or below 6%? Okay, while we wait for the fastest fingers first, to see what their thoughts are, maybe I can pick on Patrick, who exited our chat there spontaneously and came back, obviously with some connection issues. It looks like 1/3, 2/3, or 1/4, 4 quarters, 1/4, 3 quarters. Your thoughts?
Yeah, so I think a few points, to mention. One is, the outline that I gave earlier in my intro and subsequent, right? There's an element of, I guess, sort of a tactical positioning, as in over the next while, let's say 6 to 12 months out. Further out, then it becomes a completely different story, and hence some of the risks that I outlined, right? So I think it's important to have that understanding. So in answering this question also, yes, over the next 6 to 12 months, inflation has the potential to dip below the middle of the band, right? However, beyond that, whether it stays there sustainably so, it is highly, highly questionable. So a lot of things needs to happen for that to be the case. And that's the same with everywhere, even the US, for example. Right, inflation is coming down. Yes, they'll start cutting, but whether they go into their target of 2, that's going to take a lot of heavy lifting to get there. And I think one of the questions that was on the chat is around the election and Trump. If we see, and to preempt answering that question, maybe it's not only a question of if, but when Trump becomes president in November, right? There's a risk that all of those gains are actually lost, because we know his policy is expansionary. He's going to print, keep the printing press going. He's going to cut taxes. He's going to bring, sort of a lot of onshoring. That will be inflationary, which means that the ability of the Fed to continue to cut may be stymied because of fiscal policies.
I mean, I could probably just add there, probably the sort of one thing that Pat didn't mention, but which has been a major feature post-COVID, sort of wage and growth dynamics is the question of immigration, and also there, unfortunately, the sort of utterances out of Trump's campaign is that they're going to be quite aggressive in trying to curtail immigration. And why is that important? Well, one of the reasons why inflation has been better behaved in the US versus the European region, for example, or even the UK, is that the US has had significantly higher immigration, and that's had the effect of feeding a new almost a supply shock into a constrained labor market, but also the distribution of those workers has been such that it's not just low and unskilled workers that are coming across the border. The US still for all of the angst about immigration, the US still absorbs quite a lot of highly skilled, highly mobile, workers across the world, and that has had the effect of keeping a lid on wages, and that's allowed the Fed to be less aggressive in trying to attack inflation. And if they come in and they try and chase out 5 million immigrants, it's going to be disastrous.
Sure. Thanks for that. I think we can go to our next poll, and let's see. I mean, this is for the people in attendance and not for our two speakers quite yet. Although somebody's already quickly jumped on that. If you could fix one thing in South Africa, what would it be? And I'm keen to see the results of this one. I mean, I was at a session last week where they were showing some interviews from college or varsity students all in their final years and asking them what their biggest concern was. And with no exception, every single student said, I'm worried about unemployment and whether I'm actually going to, get a job when I leave varsity next year. And so I can see we've got over half the audience now. We've got, over half of them have voted, and a large majority is looking at unemployment. Patrick, your thoughts? If you could fix one thing, what would it be?
Yeah, I think unemployment, I mean, it is a thorny issue, a lot closer to home, in a lot of instances for a lot of people. So yeah, I think that's that is appropriate in terms of the responses. The other issues, yes, you can, but the impact thereof will probably take a while to come through, especially if you look at education, right? So with education, it's not a money issue. I think we're spending a lot already. If you look at our percentage of the budget allocation, I think if we were to fix it, time will be a key resource that we will need on our side before we can see the results of that. With the others, especially unemployment, I think we can do a few things to give us a few quick wins, but hopefully also, with the pro-growth policies, foreign investments coming in, hopefully that can start to make a decent dent to the current levels of unemployment, which is very high.
I want to just chat about a comment one of you made. Apologies, I can't remember who it was, and it was down to the various ministries and the majorities and the difficulty that you mentioned around getting decision making done at that level, which will affect, I mean, in my mind, all of these, including potholes, which nobody surprisingly has answered. But
must be Capetonians.
Yes. Sadila, your view on whether these ministries at that kind of level, at that influential level, to me, the real doing of the doing. I mean, do you predict that there will be high cooperation?
I'm going to be quite naughty and suggest there wasn't high levels of cooperation or effectiveness with the previous ministry. So it's one of those things, my baseline expectation is so low, things can only improve on here. And I actually think, the counter to that concern is that for the first time, a lot of ministers are not going to be beholden to, a political master somewhere in downtown Joburg. So there might actually be more accountability with people outside of your own party, who have to, be held accountable by the president. And you can imagine there's more incentive to be a lot more deliberate in holding, non-ANC ministers accountable, and making sure they're actually doing their job. So, I that's certainly, one way to look at it. On one thing to fix, I'm going to do the classic economist thing and say, on the one hand, on the other hand, and really, what's the time frame? If it's over the next year, definitely unemployment. I think the biggest error we have made as a country is not investing and improving education outcomes, and we are now sort of reaping the fruits of that. You've got kids who have been educated in sort of the new South Africa, who can't read for meaning, and who can't do simple arithmetic, and that is a massive indictment, especially as Pat has touched on. We spend an inordinate amount of our budget on education, but clearly the effectiveness of that spend is pretty poor.
Definitely. Absolutely. I wonder if maybe we can load the next poll and just gauge what people are thinking. I'm going to hop across to the chat while we do that to see if there's any other questions. So I think, okay. So we're not getting to the question I want to get to, but anyway, I'll ask it myself later. Is SA capable of maintaining economic growth in excess of 2% for 8 consecutive quarters? Briefly, Patrick, your thoughts?
Yeah, I think that the last option in terms of answers for me is key, right? So, I heard one of the officials being somewhat skeptical, saying that the only reason Eskom has been able to keep the lights on thus far, aside I guess from maintenance, is because the economy is in the doldrums, especially mining. So if mining then kicks the gear and China comes through, 2% may be a stretch, right, in terms of the overall GDP outcome, because at some point we will start to hit those constraints in terms of energy availability. So Eskom remains key, whether one likes them or not, from economic growth prospects going forward.
Sandile, thoughts on that?
Agreed.
Excellent. That can bring us to our next poll question, which I think is the one I want to ask. Oh no.
Ah, yes, of course.
The rand is currently at 18 Rand 12 to the dollar. Where will it be in 12 months? Let's stare into our crystal ball, and I guess this could link into the question. I was going to link it to the Donald Trump question of earlier that's already been touched on. But because Sandile kind of hopped out of that last question, I'm going to put him on the spot for this one.
Oh, jeez. Okay. I'm not even allowed to answer this question for compliance reasons, but since I've been naughty already, I'll give it a bash. Don't worry,
it's just between the three of us.
Excellent. I think it'll be better than now. Would be my guess, and part of that is informed by the fact that it's been cheap and is incredibly cheap. And one of the reasons why it's cheap is because sentiment around South African assets, is quite crummy. But also, if you sort of, and I'll use the word belief, but if you sort of believe that, some of the worst is behind us, then there's no reason to expect the rand to weaken significantly more than here. I mean, we for our sins have to visit our UK office now and again, and every time you go there, you're reminded just how poor you are. A sort of a really crummy coffee at a really crummy coffee shop is about 80 rands. So those sorts of things just speak to just how stretched the level of the rand is, and hopefully we'll find our way back to equilibrium a lot faster than 12 months.
I'm going to hop back to the chat because there is an interesting question here for you both, and perhaps we can start wrapping up on it. So, question to both of you: we've seen a recent spike in listed stocks recently. What is your view on whether this is obviously sustainable, and what global factors would impact us most? Patrick.
Okay, I'm not sure I fully understand the question, but nevertheless, I'll give it a stab. So yes, we have seen, listings comes through, some of them unbundling of sorts, but in the context of their listings, it's too few in my mind, so we need to see more. So some of it is, as I said, unbundling in terms of the parent company trying to, to simplify and then sort of offload so-called non-core assets. But I think, if the market continues to do well, as in re-rate, and if people, investors are able to find good value and be willing to pay for it, right? I think we could see a few more companies come back to the market, because the reason why they were delistings to start off with was simply, the executive, the shareholders then were not comfortable that the market was pricing their assets fairly, right? And so they went privately. And a lot of that was, I guess, this negative sentiment around assets, for the last decade plus. So if the topic we're discussing today, if a lot of the stuff that we've said, turns out sustainably so, then we could hopefully see a few more companies come back to the bourse.
Sandelia, quickly, your thoughts around that?
Yeah, look, I think, listings is always a function of the business cycle, So, and you're seeing it not just in SA, it's the same everywhere else. You look at the US, the number of companies listed in the US has dropped by 35% over the last 2 decades. And it's exactly as sort of, Pat has set out, you've got increasing pools of capital, a lot of them private, equity. By some accounts, private equity industry is now well over $3 trillion. 40 years ago, it was a $20-30 billion fledgling industry globally. And those companies are chasing fewer and fewer opportunities, and there's no better opportunity for them to pick up an incredibly well-run entity with incredibly good assets. If those assets are trading at a massive discount on the listed, exchange, and if they're able to do that, from whichever sector it is, whether it's infrastructure, whether it's telecoms, whether it's shipping, and sit on that asset and wait for the market rating to improve, and quadruple or quintuple the investors' money, they're definitely going to do some of that. In the past, what has impeded that process is obviously the availability of capital and the cost of that capital. But we're seeing there's still a lot of dry powder, if you will, that still needs to be deployed. From all of the capital raises that have taken place over the last sort of 5 years. So yeah, it will ebb and flow. We have probably coming out of a cycle where net you're having delistings being taken private, most companies being taken private, and it could very well improve if the rating improves in the market, or sentiment improves, or in fact if economic growth is such that private companies need to exhaust bank capital, or the provision of credit by banks and people like us on the private side, and need fresh capital injection from the listed market.
Well, it seems I can see some people are already dropping off because they've got meetings to attend, but it seems we need another whole hour to discuss the other questions that have come up, and we didn't even get to my question in the poll, which is the only question I really wanted to have the session today for, and that was, am I going to pay less on my debts from Thursday afternoon? But anyway, we will wait and see, and I won't put you on the spot for that. So
if you pay back some of it, you will.
Open like one of our financial advisors on the line right now. Sandile is not an accredited financial advisor, everyone.
No.
But thank you. I'm gonna start with the wrapping up. And for some of you, you may not be aware, but we did agree or put up a lucky draw prize, which is an education course sponsored by the ICTS Academy. We will do a random draw after the session based on all the attendees, and we will contact the lucky individual with their prize when we know what that is or who that is. So we will be reaching out to you, and feel free to go and enjoy one of the courses there. You could choose one that's the most meaningful for you. And then some important thank yous to our two speakers, Sandile and Patrick. Thank you very much for taking the time today and having this very important conversation with us. As I say, the questions are just, they just keep coming, and I wish we could deal with all of them, but thank you very much. It's definitely a very important topic that we need to be talking a lot around, and understanding if we are to position the investments of our clients and of our fund members. And so the macro context is very important for us to all understand. For the EBnet team behind the scenes, thank you for helping me with the technology, and the less said about that, the better. To our sponsors, thank you very much to ICTS Tracing Services. Thank you also very much to all of those involved in this, and as I said, very, very importantly, thank you to Sandile from M&G Investments and Patrick from Aluwani Capital Partners. I really do appreciate you taking the time to talk to me today. For those of you who have, thank you. For those of you who will be looking for CPD points, when I'm going to play a closing out video just now. And please stay on the line. You'll get a form that you do need to fill in with some of your details, and so we'll be able to make those certificates available to you. And with that, I think we've hit everything. Apologies if I didn't get to all the questions. I tried to bundle them as best I could, but yeah, thanks everyone, and have a lovely evening.